Did you know that nearly 80% of individual investors fail to beat the market over the long term? That's right, most people are actually losing money or barely breaking even, while the stock market continues to grow. In fact, if you missed just the 10 best days in the market over a 20-year period, your returns could be cut by more than half. Why is this happening? The truth is, many investors make simple, avoidable mistakes that lead to massive losses. From chasing quick profits to ignoring the warning signs of a bad investment, these mistakes can cost you big. In this article, we're going to uncover the common mistakes that most investors make and, more importantly, how you can avoid them. Whether you're new to investing or have been in the game for years, the strategies we'll discuss can change the way you approach your investments. Stick around for the secrets that can save you from making costly errors, mistakes that could cost you more than just money. Chapter 1. Chasing quick gains. The mirage of instant wealth. Investors often fall into the temptation of chasing quick gains, believing that the stock market is a shortcut to fast money. It's easy to get caught up in the excitement of hot tips or trending stocks. But, as Warren Buffett wisely puts it, the stock market is a device for transferring money from the impatient to the patient. This desire for immediate returns can cloud our judgment, making us ignore long-term strategies. A 2020 study found that most retail investors are not in the market for long-term value but rather for short-term profit, often jumping from one hot stock to another. The issue? This kind of thinking is exactly what creates massive losses. The truth is, investing for the long term is often the smarter route. Think about it. If you invested $10,000 in the S&P 500 back in 1957, by 2020, it would have grown to more than $1.1 million. That's the power of patience and compound growth. Trying to time the market or chase quick gains often leads to buying at high points and selling when things go south. So, the next time you hear someone rave about a surefire stock, remember, true value investing is about solid research, not fast money. Chapter 2. The overconfidence trap. When ego blinds your portfolio, overconfidence can be a dangerous enemy in investing. If you've ever thought, "I know this market inside and out," you're not alone. A study from the University of California found that overconfident investors tend to trade 45% more than others, often resulting in lower returns. They believe they can predict market trends better than the average investor, but the numbers don't lie. Buffett himself has warned against the dangers of thinking you know everything. The more you learn, the more you realize how little you know, he says. Overestimating your ability to make successful investments can lead to poor choices and unnecessary risk. This is especially true in volatile markets, where emotions often take the reins. A smart investor is always looking to learn and evolve, no matter how successful they may be. Remember, humility is key. Even the best investors, like Charlie Munger and Bill Ackman, admit that they have made mistakes along the way. Acknowledge that you don't know everything and be willing to listen to expert opinions, do your own research, and stay humble in your approach. Data shows that the most successful investors are those who stick to proven strategies rather than trying to beat the market with risky bets. So, before you make that next move, ask yourself if it's backed by careful research, or if it's just a result of overconfidence. Chapter 3. FOMO. Fear of missing out on the next big thing. Fear of missing out, or FOMO, is a powerful force that can lead to disastrous investment decisions. Every time you hear about the latest tech startup or that next big stock, it can feel like you're about to miss a huge opportunity. But falling for FOMO can lead you straight into bad investments. Take, for example, the dot-com bubble of the late 1990s. Investors, driven by FOMO, poured their money into tech companies without considering the fundamentals. By 2000, many of these stocks collapsed, leaving investors with massive losses. The same thing happened with the 2008 housing crisis. People jumped on the real estate bandwagon, thinking the market would keep rising. In both cases, FOMO led to bad financial outcomes. The problem with FOMO is that it clouds judgment. Investors start buying without understanding the true value of what they're purchasing. A stock might seem like a great deal because everyone is talking about it, but without research, you have no way of knowing if it's truly undervalued or just overpriced hype. To avoid falling into this trap, always remember that investing is about the fundamentals. What is the company's financial health? How does it compare to its competitors? What are the long-term growth prospects? If you can't answer these questions confidently, don't get swept up in the hype. Take, for example, the case of the Bitcoin craze in 2017. Investors rushed in, fearing they'd miss out on huge profits, but the market crashed, and many were left with empty pockets. Patience and careful analysis are the antidote to FOMO. A solid value investor waits for opportunities, does their research, and focuses on long-term gains instead of short-term fads. If you found this chapter helpful, don't forget to subscribe and hit the bell icon for more investing tips. We have plenty more to cover that will help you avoid costly mistakes. Chapter 4. Neglecting the power of patience. Why timing the market is a gamble. One of the most tempting mistakes for investors is trying to time the market. The idea that you can predict exactly when to buy low and sell high is an alluring thought. However, this approach is often more about luck than strategy. Patience is a cornerstone of value investing. Legendary investor Warren Buffett often says, "The stock market is a device for transferring money from the impatient to the patient." The key here is long-term thinking. The market moves in cycles, and while there are short-term ups and downs, it's the long-term growth that brings real rewards. A great example of the power of patience can be seen with the S&P 500 index. If you had invested $1,000 in the S&P 500 in 1980, by 2020 that investment would have grown to over $50,000. The stock market has its crashes, but the historical data shows that, over time, it always bounces back. In contrast, trying to time the market often leads to missed opportunities. Research by the financial website JP Morgan shows that missing just the 10 best days in the market over a 20-year period can cut your returns by more than half. It's clear that trying to catch every market move is not only difficult, but it's also a strategy that can cost you big in the long run. Instead of trying to outguess the market, a more effective strategy is buying undervalued companies and holding them for the long term. Take the example of Coca-Cola. Investors who purchased stock in Coca-Cola in the 1980s and held it have seen incredible returns, proof that patience in investing pays off. So, the next time you feel the urge to time the market, remember that the best returns often come from sitting tight and waiting for your investments to grow. Chapter 5. Ignoring the warning signs. How to spot a value trap. One of the trickiest pitfalls in investing is falling for a value trap. A value trap is when a stock looks cheap on the surface but, in reality, has serious problems that make it a poor investment. It may seem like a bargain, but buying in could hurt your portfolio. For instance, in the early 2000s, General Electric, GE, was considered a great stock by many, but it was later revealed that its financial health was far worse than expected. The company's stock plummeted as a result of poor management and unsustainable practices. A classic example of a value trap. So how do you spot these traps? First, be cautious of companies with declining revenue, high debt levels, or consistent losses. A low price-to-earnings (P/E) ratio may seem attractive, but if the company's future prospects are dim, the stock could continue to fall despite its low price. To avoid value traps, look for companies with strong balance sheets, low debt, and a solid track record of profitability. Also, consider industry trends. Companies in declining industries may be cheap, but they might not have the long-term prospects you're looking for. It's important to not just look at a stock's price but also its story. Take the time to research the company's management, competition, and market environment. According to financial experts like Joel Greenblatt, investing isn't just about finding cheap stocks, it's about finding companies with real potential that are temporarily undervalued. Remember, a stock may seem cheap, but if it's not backed by solid fundamentals, it's a trap waiting to happen. Always dig deeper and make sure the price aligns with the company's true value. Chapter 6. The herd mentality. When following the crowd equals losses, it's easy to get swept up in the excitement of what everyone else is doing. Whether it's the latest tech IPO, a trending stock, or a hot cryptocurrency, the herd mentality often leads investors down the wrong path. The problem with following the crowd is that everyone else is often reacting emotionally to market news. This herd behavior causes people to buy when prices are high and panic sell when they're low. It's a cycle of fear and greed, and it's often the cause of significant losses. Nobel laureate Daniel Kahneman, in his book Thinking, Fast and Slow, points out that people tend to make irrational decisions when they rely on their intuition in the face of uncertainty. In investing, this often results in poor decision-making driven by the crowd's emotions, rather than sound analysis. Take the example of the 2008 financial crisis. Leading up to the crash, housing prices were soaring, and everyone was eager to jump into real estate. Many investors, thinking they were part of the smart crowd, ignored the warning signs. When the market collapsed, those who followed the herd were hit hardest. To avoid this mistake, focus on your own strategy rather than following what others are doing. Make decisions based on thorough research and your long-term goals, not short-term emotions or market trends. One of the best ways to avoid herd mentality is to have a strong understanding of your investment strategy and stick to it. Value investing isn't about jumping on the latest trend. It's about finding quality companies with strong potential and holding onto them for the long haul. As Buffett famously says, "Be fearful when others are greedy and greedy when others are fearful." In other words, don't follow the crowd when everyone else is making emotional decisions. Stick to your own strategy and ignore the noise. In conclusion, the mistakes investors make can often be traced back to common psychological traps. Whether it's chasing quick profits, overestimating your abilities, or following the herd, these mistakes can lead to major losses. But by focusing on patience, avoiding value traps, and sticking to your own strategy, you can avoid the pitfalls that so many others fall into. The key to successful investing isn't about outsmarting the market. It's about understanding it, staying disciplined, and making decisions that align with your long-term goals. By following these strategies, you can avoid costly mistakes and start building wealth the right way. If you've enjoyed this video, subscribe now for more tips on how to avoid mistakes that could cost you big in investing.